Hello viewers, in today's video I'm going to discuss and explain the concept of capital gains and losses and their treatment under the Canadian tax law. So to understand the treatment of capital gains and losses in Canada, you need to comprehend few basic concepts like capital property, adjusted cost base, capital gain, capital loss and inclusion rate. Now, what is a capital property? This includes depreciable property and any property which, if sold, would result in a capital gain or a capital loss. You usually buy it for investment purposes or to earn income. Capital property doesn't include the trading assets of a business such as inventory. Some common types of capital property include cottages, securities such as stocks, bonds and units of a mutual fund trust, land, buildings and equipment you use in a business or a rental operation. So what is a capital gain? You have a capital gain when you sell or are considered to have sold a capital property for more than the total of its adjusted cost base and the outlays and expenses incurred to sell the property. Similarly, what is a capital loss? You have a capital loss when you sell or are considered to have sold a capital property for less than the total of its adjusted cost base and the outlays and expenses incurred to sell the property. Now this term adjusted cost base, usually the cost of a property plus any expenses to acquire it such as commissions and legal fees. So this is called adjusted cost base. So it may be calculated as shown in this example. So adjusted cost base or ACB is equal to, if we apply this formula, cost of property plus expenses to acquire it such as legal fees, commissions, etc. So we assume that the cost of property is $50,000 while expenses to acquire it say about $25,000. So in this case the adjusted cost base would be $75,000, that is the sum total of $50,000 and $25,000. Similarly, we can also look at the example of capital gain. So capital gain may be calculated using the equation proceeds of sale minus adjusted cost base minus expenses to sell property. So again, we assume that proceeds of sale are say $100,000 and adjusted cost base as we just calculated earlier is $75,000 while expenses to sell property are say $5,000. In this case, the capital gain will be $20,000. That is basically the difference between $100,000 minus $75,000 and minus $5,000. We can slightly modify the values to look at an example of capital loss. So equation will remain the same, that is proceeds of sale minus adjusted cost base minus expenses to sell the property. But in this example, the proceeds sales are assumed to be the same $100,000 while adjusted cost base is a slightly enhanced value, say $90,000. And expenses to sell property are also $15,000. So in this case, there's a loss of $5,000 because $100,000 is a lower sum of money when you add up $90,000 and $15,000 to compare. So $5,000 will be your capital loss. Now another important term that you need to keep in mind is the inclusion rate. For 2001 and subsequent years, the inclusion rate is half, implying that only 50% of capital gain is taxable in the year of sale in Canada, while the other 50% is tax-free. So any capital gain will be reduced by 50% and then it will be shown as income for that year in your personal income tax return. Now another important question is when and where do you report a capital gain or loss? So you need to report the disposition of capital property in the calendar year, that is between January to December, you sell or are considered to have sold the property. Capital gains or losses are usually reported in Schedule 3 of the income tax return. Now, another related question may be when do you have a capital gain or loss? So let's explore it in a little bit more detail. Usually you have a capital gain or loss when you sell or are considered to have sold capital property. The following are a few examples of cases where you are considered to have sold capital property. Of course, the list is not exhaustive. You exchange one property for another. You give property other than cash as a gift. Shares or other securities in your name are converted. You settle or cancel a debt owed to you. You transfer certain property to a trust, etc. Now, what happens if you have a capital gain? Well, if you have a capital gain, you may be able to do one of the following. First option is claim a reserve. So it means defer part of the capital gain by claiming a reserve if you are likely to receive sale proceeds in installments spread over several years. For example, you sell a capital property for $50,000 and receive $10,000 when you sell it, and the remaining $40,000 over the next 4 years. If this happens, you may be able to claim a reserve. Usually, a reserve allows you to report a portion of the capital gain in the year you receive the proceeds of disposition. Second option is claim capital gains deduction. How it works? Reduce or offset all or part of the gain by claiming a capital gains deduction that is applicable in your case. There are different capital gains deduction limits for different types of capital properties for each tax year, but of course this will be left for another video. Now the final question is, what happens if you have a capital loss? Then in this situation there are three options available for you. So say this is year 2020 and you have a capital loss. So what you are going to do? First option is same year adjustment. That is, adjust capital loss against capital gains of the same year, that is say year 2020. Second option is past 3-year adjustments. Any excess capital loss may be net off against past 3 years capital gain. So it means the capital gains that you had in the past year, you may adjust those capital gain against this loss of current year, capital loss of current year. And third option is future periods adjustments. Alternatively, if you don't want to exercise the first two options, you don't have those options, you can carry forward a capital loss to any number of future years to offset it against future capital gains. I hope you enjoyed this video. Thank you for watching.